Welcome to this presentation on the tax advantages of ESOPs. Over the next slides, we'll walk through how employee stock ownership plans can create tax-efficient outcomes for companies, sellers, and employees, and why these structures are increasingly used for buyouts, retirement planning, and business continuity. I'll point out key mechanisms and practical considerations as we go. This slide shows how a C corporation can use an ESOP to finance a buyout while capturing tax benefits. The company funds an ESOP with pre-tax dollars, borrows to complete the purchase, and repays the loan through company cash flow. Those repayments and ordinary dividend deductions lower taxable income over time, as illustrated by the downward tax curve on the chart. Here we look at capital gains deferral for owners who sell to an ESOP. When an owner sells at least 30% to an ESOP, it creates a liquidity event that can qualify for a tax-free portfolio shift by reinvesting in qualified replacement property, potentially deferring capital gains indefinitely if IRS timing and security requirements are satisfied, preserving proceeds for future use. This diagram explains how ESOP cash dividends can be deductible for a C corporation. Company earnings can be used to retire the ESOP loan or be passed out as dividends to participants, and both paths are generally tax-deductible, effectively reducing corporate tax costs to zero, while simultaneously rewarding employee accounts and supporting the repurchase reserve. S corporation ESOPs can offer a powerful tax-exempt status when the ESOP is the tax-exempt shareholder. S corp earnings flowing to the ESOP trust are typically shielded from federal income tax, and in many cases state tax as well, allowing a 100% ESOP-owned firm to operate with virtually tax-free earnings that boost cash flow, reduce debt, and support growth. Maintaining the S-Corp ESOP tax advantage requires compliance with IRC Section 409P, which prevents ownership concentration among disqualified persons. The rule ensures benefits are broadly shared, producing meaningful allocations for rank-and-file employees, and aligning tax savings with public policy goals by promoting widespread employee ownership and economic stability across the workforce. From an employee perspective, ESOPs offer allocation and growth, defined distribution rules, and long-term wealth accumulation. Shares allocated to participant accounts grow pre-tax. Distributions are taxed on payout with penalties for early withdrawal, and rollovers to an IRA can delay taxation further, ultimately converting ESOP balances into portable retirement wealth for financial security. ESOPs and 401k plans create dual retirement channels that align employee and corporate success. The ESOP brings company-funded share ownership, while the 401k provides employee-funded, diversified savings. Together, they translate company prosperity and share appreciation directly into employee wealth, reinforcing aligned goals and motivating performance that benefits both individuals and the business. Implementing an ESOP and locking in tax optimization involves clear steps: complete a feasibility study, obtain an independent valuation, draft a RISA, compliant plan documents, line up a trustee and lender, model repurchase obligations, choose S or C status strategically, and monitor 409P tests annually. Consistent annual compliance is key to sustaining tax benefits and operational efficiency.